Did you know that there is a single tax strategy that can reduce your taxable income by six figures every single year and change the way that you invest and build wealth with real estate? Well, it's called real estate professional status, or otherwise known as REPS. And if you're not using it, you're leaving money on the table. Let me tell you why REPS matters and how you can qualify. Thank you. Welcome to the channel. My name is Tim Johnson. I am a real estate consultant. I uncover and share as much tax savvy or real estate advice that I can because, to be honest, we're dropping the ball on this stuff. CPAs are dropping the ball. Nobody specializes in real estate. Nobody knows what's going on. And there's a phrase that I've heard that really solidifies every time that I talk with somebody, no matter how much experience they have, no matter how many rentals they own, you don't know what you don't know. And so my goal here with these videos is to uncover what you don't know so that you can no longer live in the dark and you need to be taking action with the things that I'm telling you. So in this video, I'm going to be breaking down three things. I'm going to break down what is real estate professional status and why is it powerful or why is it important? Why should you continue to watch the video? Number two, I'm going to talk about who qualifies for real estate professional status. So there's a lot of myths about who qualifies, who doesn't. You're going to find all sorts of answers if you look on the internet. But I've done the hard research, the digging. I've read the IRS, the Internal Revenue Code. I've looked at the tax court cases. I've looked through Publication 925. If you're a CPA watching this video, I've done my homework. Okay, so and number three, I'm going to be talking about really why reps is the most powerful tax strategy that I believe exists, right? There's two industries that are incentivized by Uncle Sam more than anything else. It's business owners and real estate, maybe oil and gas above them. But real estate and business owners, if you can marry the two together in your tax strategy, you're probably not going to be paying a whole lot of tax, if any at all, year in and year out. Because why? The IRS wants to incentivize you to keep investing in those industries. It's good for their economy. It's good for everything that they do, right? Okay, so let's dive in. What is reps? I'm going to go ahead and share my screen here so that way it's easy for everybody to go ahead and follow along. All right, so in order to understand why real estate professional status is important and how powerful it is, we've got to take a quick step back and look at how the IRS views your income. Okay, so I'm going to draw this out. We've got, oh my goodness, what's going on there? Let's erase that. Okay, so we've got the IRS. They exist right here. They're going to draw a line down the middle of your life, okay? They're going to split your income into two sections. You're going to have passive income over here, and you're going to have active, or for all of you CPA nerds, non-passive income over here, right? So this is the first step that we take when we sit down with a new client is we actually map this out. So for the client, we're looking at, hey, what active income do you have coming in? Do you have a W-2 job? Does your spouse have a business that they own that they're paying themselves 1099? They have K-1 distributions, right? That's probably what the active side is going to look like. And in terms of passive, you might have, a retirement account over here. You might have, did you buy some Bitcoin this year? Maybe you've got something like that. And then also, this is where rental real estate is categorized by the IRS. So no matter how much time you spend in a rental, if you own a rental property, no matter how much time you spend in that rental, the IRS is always going to deem it passive, which kind of sucks, right? Because if you've got losses here, and for anybody who owns real estate, they know that this is the ultimate power and this is the ultimate benefit of real estate is to be able to show losses pretty easily against income. You might be cash flowing on a property, but at the end of the day, come tax season, you probably are able to show a loss with that property. Well, the IRS says, hey, Mr. Taxpayer, you have to operate with our rules right here. You cannot cross this line that I just drew. So any losses that you create with your rental properties is going to be subject to staying on the passive side, right? They can only offset other passive gains, right? So maybe I have a capital gains from another property that I just sold. I could offset some of that gain with losses from one of my other properties, but I've got to play by the rules. I've got to stay on my lane, right? Same thing. If I've got business losses, hey, those are going to offset business income, but I cannot offset passive income and go the other way. Now, there's one election that the IRS allows, only one right here, and it's if you qualify as a real estate professional. They allow you to take losses from rental properties and deduct that versus your active income. So what that looks like is, okay, let's say that, you know, you qualify as a real estate professional. And in the next piece, I'm going to go ahead and explain who actually qualifies as a real estate professional. But rep status, right? So I've got that status. And now when I create, let's just say 100K in losses with my rental real estate, that can now come and cross this line. The IRS says, hey, if you materially participated in that rental property, right? You qualified as a real estate professional and you made that property an active form of business. It's no longer passive. We're going to allow you to go ahead and move that on over here, and we're going to help you offset that income from your business or maybe your spouse's W-2. There's all sorts of awesome things that you can do once you qualify for this. So let's get into the next piece of this is who the heck qualifies as a real estate professional, right? This is where all sorts of misconceptions that you will see online play into effect. People think that only real estate agents qualify. People think that only full-time real estate investors qualify. Well, let's just dive in and see who the IRS says qualifies. That's probably the best place to start, right? So let's go ahead and start here. You've got to be able to spend more than 750 hours, okay? More than 750 hours. I apologize for the terrible drawing here, but you've got to spend more than 750 hours in a real property trade or business. Okay, so you've got to be spending full time essentially, and not really even full time. That's 15 hours a week, to be honest. So you could be doing this as a full time real estate investor. Sure, you could be running a real estate investing company where you're buying and managing properties and selling them and doing all sorts of stuff with real property. But what about all the other people that kind of fall into that category, right? Well, let's go ahead. Who qualifies as a real property trade or business? This is where most people get stuck, right? So the IRS deems that you have a real property trade or business if you do any of the following: develop or redevelop real property, construct or reconstruct real property, acquire real property, convert real property, rents or leases real property, operates or manages real property, or maybe you broker real property, right? As an agent, I'm part of that brokerage service. So there's a lot of misconceptions about who qualifies and who doesn't. Well, if I'm, a contractor and I'm working in construction and reconstruction of real property and I am very much a part of building those homes and that's my business, right? Then I am operating a real property trader business. Okay, so now I've qualified in one way. Now I've just got to make sure that when I do buy and own property as rental property, I materially participate in that rental property. So I've just got to spend 100 hours in the year and make sure that I'm the one managing that, right? Long-term rental property should be fairly low maintenance. Once I have a tenant in there, there's not really much I'm doing to go ahead and manage that property. So in order to qualify, when I first buy that property, I want to go ahead and spend probably the first couple weekends getting that thing, all did up, ready for somebody to move in, ready to market it on the market for a tenant to move in. So I'm going to go ahead and spend the first couple weekends with my spouse there, renovating the property, getting it ready, list ready. I'm getting it ready to market. I'm taking care of the landscaping. I'm doing some repainting touch-ups. I'm replacing some, knobs around and fixtures throughout the house. I'm spending time in that property. And then I'm probably going to hit most of those hours just in the first couple weekends. After that, for the rest of the taxable year, I'm going to go ahead and be managing the tenants. I'm going to be, reaching out to them, collecting payments, drafting documents for them. All of that stuff is going to go ahead and add up to my collective 100 hours of material participation. Okay, so that kind of goes into our next piece, which is I've got to be spending more than half of all of my time in this real property trader business. Okay, so I can't be a full-time dentist and also a real estate investor and be showing that I, spend more time in dentistry than I do in my real property trader business. I've got to have accurate logs to show, and if I do have a full-time business that's not a real property trader business, you better have accurate logs down to the detail that you spent more time in that real property trader business than you did in your dental practice, right? For example, this is where I've read dozens and dozens of tax court cases. This is where everybody gets their hand slapped, and this is where they say, "Hey, you don't actually qualify as a real estate professional because you didn't actually, document this very correctly." Whether the taxpayer was right or not, they didn't have the correct documentation. Okay, so you've got to be spending more than 50% of your time in that real trader business. And then the last qualification here is you've got to have at least 5% ownership of that business. Can't be an employee of the business. I'm sorry. So, hey, maybe you're looking at the list that I gave you and you're saying, "Oh, well, I'm a property manager. Yeah, I qualify as a real estate professional." Well, not fully true. If you don't own at least 5% of the business that you work for or work in, then they don't count you, right? You're not actually materially participating in that real property trader business. You're just an employee. Okay. So, in order to capture the benefits, that is who qualifies. You got to be spending 750 hours or more. You got to be more than half of all your time, and you got to own at least 5% of that business. And then I went over already what actually qualifies as a real property trader business. So let's get into the next piece of this is why does this matter, right? How is this actually going to change the way that I build wealth with real estate? Well, we're talking about deferment of taxes here, right? So you're not eliminating your tax burden altogether forever. Although you can, if you carry out this plan, and this is how we work with clients actually, is we say, hey, let's go ahead and start and build a long-term plan where you're going to pass these properties to your kids. When you die, you actually get a step up in basis, which means, hey, everything resets, the value of those properties reset, all the tax deferral that you've been able to push off resets. So actually, if you want to really get technical, you actually can get rid of the entire tax burden completely upon death, right? And so we're going to go ahead and find and work with strategies with our clients to go ahead and defer as many times as we can. Also, you never pay tax. You never pay, recapture tax or anything like that that you've heard about when you run a cost segregation study or anything. You never pay those unless you sell the property. And in that case, if you sell the property, you can still 1031 exchange and defer that tax liability even further. So there's lots of ways to continue to kick that can down the road. Kick the can until you kick the bucket. That's what we like to say. And so why does this matter, right? So let's take this for example. You cannot depreciate land, but we're going to go ahead and try and be what this strategy is we're going to be accelerating the depreciation schedules of your rental properties. So we want you to buy real estate, whether it's commercial, whether it's residential, whatever it might be, and we're going to probably run a cost segregation study on that real estate. And what that allows us to do is instead of taking straight line depreciation, we accelerate the depreciation, which creates that big old loss that I was talking about. So let's say that we've got a house here and we're going to go ahead and run a cost segregation study on that. And at the end of the year, it cash flowed great. Maybe I made 10K on rents that year and it cash flowed fine and awesome. Well, I'm also going to actually be showing a paper loss because when I run a cost segregation study on this property, I'm actually going to be able to take about, let's say, in this taxable year in 2024 that we're in right now, maybe around 20% of the structure value. Okay. So let's say the structure value of this house is worth 500K. Let's say I bought it. So you bought it for 600,000. What am I doing here? You bought the house for $600,000. The actual house is worth $500,000. Let's say the land was worth 100. Okay. So then I'm going to take about let's just ballpark this. Let's assume that I run a cost segregation study on it. Let's say I get $100,000 of losses here on my Schedule E at the end of the year when your CPA files your taxes. What do you do with that, right? That's $100,000 of losses. Well, if you qualified as a real estate professional and you materially participated in that rental property, guess what? Guess what we get to do? Right here, you get special treatment. Uncle Sam loves you because you know what? You're running a business and you're investing in real estate, and those things are good for Uncle Sam. They don't fund, the government doesn't build our buildings. They don't, build everything. No, this is private sector, right? And so the more they can incentivize people to build our economy, the more incentives they're going to give through the tax code. let's be honest, that's really why the tax code exists. It's to steer you, the taxpayer, towards different industries that overall help our economy, right? The tax code is like 6,000 pages long. It's full of ways to not pay tax. It's the guide, right? It's the guide to not paying tax. Yet nobody wants to read it. It's boring. It's terrible. It's, whatever. So if you can create $100,000 of losses right here with a single property, and then you go ahead and cross this line. Let's just say we've got this active passive line, and we cross this line, and I'm in the highest tax bracket, right? Maybe I'm paying 37% federal annual federal income tax. Okay. If I have $100,000 to reduce my taxable income by with a single rental property, this isn't anything crazy. We're in the Phoenix market, right? $600,000 is almost typical for a single family house here. And if you're able to get $100,000 in losses that you can show in that year that you bought that property, oh my goodness, what does that turn into, right? So if I've got 100,000 and I'm going to multiply that by, 37%, right? What does that give me in actual tax savings? Guys, right there. You've reduced your taxable income by 6 figures, what I said in the beginning of this video, and you have an actual tax savings. You would have paid Uncle Sam this money come tax time, right? And now you get to keep $37,000. Guys, this scales up. So let's say I bought $1 million property. Let's say I bought a $2 million property. Let's say I bought multiple single family homes in a single year, and because I knew that I wanted to invest in real estate and I knew that I wanted to offset my taxable income. Oh my goodness, this is what happens, right? I'm now able to go ahead and snowball the gains. This is why this is powerful. I'm now able to snowball the tax benefits that I'm experiencing from running this strategy into more real estate. So instead of running like a BRRRR strategy, right, when I'm going to go ahead and I'm going to rehab the property, and then I'm going to refinance all my equity out, and I'm going to take my money that I initially used to buy that property and I'm going to roll it into the next one. Well, that requires us to sometimes over leverage an asset that's not necessary. But when I can just utilize something that's already there in front of me, like the tax benefits, this is something that nobody talks about, right? We've gotten lazy over the last 10 years in real estate. Nobody looks at the tax benefits. Your CPA is missing it. If they don't specialize in real estate, which there's probably a 99% chance that they don't, they missed it, right? If you're not in the trenches in real estate investing groups, you probably never heard of this. So what happens when you, as a general contractor, or you as a real estate agent, you're looking at ways to build wealth, right? You want to invest in what you know, you want to invest in real estate. Well, you're kind of looking and you're kind of like, hey, I mean, interest rates are really high right now. I'm not sure I can find a property that cash flows, but my business is killing it, man. I have a tax liability. What do I do? My CPA has kind of run out of options. I've deducted everything under the sun when it comes to making business deductions. What do I do? I want to invest in real estate, but I just I'm paying a lot of tax too. Like I got to save money for that. Oh my goodness, this is the 1-2 punch, people. We can intensify and optimize the tax benefits of the real estate that you're investing in. And in return, you're going to snowball effect. I mean, you and a peer who might have the same income over the next 5 years, your life is going to look massively different. You're going to have assets galore that you've invested in. You've been able to eliminate your tax burden. You're investing that money that you would have paid to Uncle Sam in hard assets that are appreciating, that you have tenants paying down the mortgages on, that you're creating cash flow with. Your life looks a lot different when you run a strategy like this. And this isn't common knowledge. It just isn't. I've seen very little information about it. I've talked with lots of CPAs, tax attorneys, people who have been in the industry, longtime real estate agents who have helped thousands of people buy and sell properties, and they know nothing about this, and it amazes me. At this point, it's not amazing, but it amazes me for so long how many times I would talk to somebody and I would assume that this was just common knowledge, right? And I'm lucky to have stumbled upon it so early on in my career. It took me 4 years not knowing about this, the tax benefits associated with real estate. I was a full-time real estate agent and investor and still am, but now I look at it through a different lens and I can help consult and help you build wealth with real estate in the same ways. right? And capture the full benefits of real estate, the tax benefits included. Okay. So if you found this video helpful, this is like one of my first videos. If you found this video helpful, hit the like button, subscribe. I want to share more tax savvy real estate tips for you. I'm going to be dropping out new strategies. There's all sorts of ways to kind of use real estate to go ahead and lower your taxable income, whether you're on the active side or the passive side. There's all sorts of cool things that we're helping clients do. Whether you own 10 rentals right now, reach out, go ahead and shoot me an email. I'm going to drop all my contact info below. I'm a real person. Shoot me a text, shoot me a call. If you're just curious, you don't know your numbers. Maybe you're saying, hey, I own 5 to 10 rentals, and I'm not really sure that I have captured the benefits of the tax benefits that are come with it. I feel like my CPA maybe dropped the ball. I've had clients who own real estate who their CPA didn't even file for them for a couple of years. Never asked them if they own real estate. Now that's a two-way street. I was, don't blame it all on the CPA. I blame it's partially on the client as well. He didn't mention to the CPA that he owns rental properties. But all that said is, there's ways for us to help. Let's jump on a call. Let's figure out, let's problem solve what you got going on. Even if you're curious at, hey, am I actually maximizing this? It's really easy for us to know that within the first 10, 15 minutes of jumping on a call together on whether we can actually provide some real value to you. You might be leaving hundreds of thousands of dollars on the table by not knowing how to run a strategy like this. And so if you want help implementing and knowing more about how to run that strategy, reach out. And as always, click that like the bell notification thing and everything below. So hope you have a great day and see you on the next video.